I don't think it changed the topic for restream, right? This is still 3rd of April. The 10th of April. This one is done. Okay, testing, sound check. Everything's okay. Do we need to tell the guy that we are live?
He said he'll be ready, but
Mm.
okay, no, there's there. Oh yes.
Wait, give us a minute while we just set up the the webinar, right? Because we're streaming to quite a number of places, so so I just need to coordinate. Yeah, we just need to coordinate everyone. Just give us a quick minute, right? And Keaton will be taking you through today's breaking news and setups in a bit. All right. Okay. All right. We should be able to see the question. Let me just say hi. Let's see the question. All right. Okay, hi everyone. Thanks for taking the time to tune in to today's session, right? It's on the what we're going to cover is the breaking news and setups. All right, just give us just one last quick second when I just check. All right, we are a little bit kind of okay. It's fine. Okay, it's all good over here. Now, how do I rotate back? Okay, just rotate back. Oh, maybe need to exit.
Oh,
yeah, right. Okay, all looking good. All right. So all IT checks are done. Thank you for your patience thank you for your patience for waiting for us to set this up. Right. Yeah. So today's webinar, every Monday, what we do at Vantage, right? We are streaming on YouTube Live, we're streaming on Zoom, we're streaming on the Vantage mobile application. If you don't have the Vantage mobile application, go and download it, right? It's a much more optimized viewing experience, and we monitor most of the questions that come through here, right? So yeah, every Monday we look at what are the key news events for the week ahead, right? So this is very important for traders in order to position yourselves, what we're expecting from a fundamental and technical point of view, because once we know like what's the direction, what's the bias that we have for the dollar index, right, for the euro dollar, for oil, for gold, right, it'll be much easier for us to take positions throughout the rest of the week. All right. So yeah, today's session will be done by Keaton. right? He will be going through not only PowerPoint slides, but also Forex Factory, right? Some of the news events for you to look out for, and trading views and the charts to look at. Okay. First and foremost, I do want to let you guys know that everything in this webinar is educational in nature, so nothing should be construed as investment or trading advice. Please do your own little due diligence before you guys trade. I want to encourage everyone that we have 3 screens that are open over here, monitoring questions that are coming through. So if you have the chance, right, don't wait until the end, right? Whether it is questions within about the webinar, or you have specific requests you want us to look at. For example, what's our view on gold? What's our view on oil? Right? Send your questions through. Right? Keaton will be monitoring these different screens, and he'll be able to give you, if there's time, attend to your custom requests on these certain instruments that you want us to more specifically look at. But yeah, don't hesitate to ask us questions. We literally have like 3 screens open, right? Monitoring the questions that you guys are sending through. All right, so yeah, I'll be passing the time on now to Keaton. He'll be sharing with you what are the main talking points he'll be covering today, right? And all right, already see a question from Andrew, update on gold, right? I guess Keaton, right? Take note of that. Right? Update on gold, right? If you want, you guys can when you send questions, you can put if you're on Zoom, you can send it to everyone, right? So we can also see what other questions that other people have. All right. Thank you very much, guys. Keaton, over to you.
All right. Thank you very much, Desmond. Hello, everyone. Good morning, good afternoon, and good evening from wherever you're tuning in from. I hope you've had a good long Easter weekend. And for some people, it's still a holiday today, like in Australia, New Zealand, and Europe as well. So they've got a long 4-day weekend. Right. Okay. So we have first questions already come in. Please update on gold for sure. Yes, we'll be going through that as we approach the section as we go down the line. All right. So, right. Okay. We've got Andrew, Chris, Emil. All right. Welcome, guys. Thank you. Good to see you. Got a few. Okay. Yes. Questions coming through, or comments coming through on the Web Vantage app as well. Right. Okay. Is gold going to 270 this week? What's your view on gold and oil today? All right. Sure. Okay. So questions on gold and oil have come in. Yep. We will definitely progressively cover these topics as we move down the agenda. All right. Okay. So NFPs, non-farm payrolls, right? Okay. So this was announced on Friday, Good Friday itself, 7th of April at 8:30 p.m. UTC +8. Okay. So this was when the markets were closed, except for the bond market, which was open for trading for half a day. So results were announced at 8:30 p.m. UTC +8. Okay. Pound yen. Okay. All right. Okay. And so basically, the non-farm change came in higher than expected. The consensus or the forecast was for a figure of 228,000, and we had a figure of 236,000, whereas the unemployment rate edged lower to 3.5% as well. So now why this is important, because on that day, bond markets were still trading and bond yields actually shot up. They increased because this shows that the labor market is tight, as we see in the next slide. Over here, we have the total non-farm payroll numbers on the left, and you have the unemployment rate on the right. So we've got a very strong labor market in the US, which means that the Fed could probably squeeze in one more rate hike, which is coming up in May. So the next FOMC meeting in May would be in May, and there is a slight possibility that the Fed may still continue to raise interest rates based on a strong labor market. But the key economic data released this week will be the CPI numbers coming up on Tuesday, right? So if you quickly look at Forex Factory, let me just switch over. Yep, can you guys? Yes, have you switched over to Forex Factory? Yes. Right, can you guys? Wait, hang on. Yes. Okay, sorry. Do you guys see the Forex Factory screen, or are you guys still looking at the non-farm payrolls? Okay, hang on, just let me see. Let me see if I can put up Forex Factory here. Sorry, it's a bit of a lag coming in. Okay, I think it's not being updated on, I don't see it on the app. Okay, so basically we have CPI, US CPI figures coming in on Wednesday, sorry, not Tuesday, but Wednesday, 12th of April at 8:30 p.m. UTC +8. So this is going to be a key economic event that will drive the moves for the rest of the week. So if a softer CPI number comes in, or which is in line with consensus or better than consensus, it is very likely that bond yields will start selling off, and that would mean that the dollar index would also continue to weaken. Okay, so this is one of the key events that will be coming up. So let's just head on back over to the slides. Okay, so we'll quickly head back up to the slides. Right, okay. Just no question. Okay, thank you. We had a update that we could see the Forex Factory page. That's great. Okay, so now I'm back onto my slides. So just quickly look through at some of the PMI reports that were released last week, because this would help us determine how the CPI number would probably print this week. Okay. So quickly, we'll just look at the global composite PMI number by JP Morgan. So as you can see, the services sector is pulling up the total composite PMI. Manufacturing is lagging at a global level, while services have picked up pretty strongly. What I would like to point out in this picture here on this chart is looking at input prices and output prices. So basically, this relates to inflation at a global level, right? Okay, so any reading above 50 means that particular index is expanding. Any reading below 50, it means it is contracting. Okay, so what is this telling us? It is telling us that although input and output prices are still expanding, they are doing so at a slower rate. So generally, this is quite encouraging, so that we know at least inflation at a global level is trending lower. Because this is important because all central banks are reacting to the inflation figures. Okay, so next up, we quickly look at global commodity prices and supply. So what we're looking at here, the yellow line is showing us the index for price pressures, and the green line for supply shortages. So basically, we're just looking at supply chain issues and pricing issues. So as supply chain issues went up, naturally the prices of commodities also went higher, and we can see they have peaked and have been trending down quite significantly. So this is very important, because as price pressures comes down, supply chains improve. It means that shipping and freight costs are dropping as well. So this all feeds into the overall inflation picture. So from a logistics point of view, shipping rates, freight rates have all peaked and have continued to fall down pretty significantly. So this means, at least at a global level, price pressures should continue to trend lower. Okay, next we had the ISM PMI report. So this relates to the US economy. So we'll be looking at the manufacturing and services sector of the US economy. So this was the reports or surveys for the month of March. So as you can see from the charts, the US economy is clearly in a two-speed economy. So what do we mean by that? So what do we mean is manufacturing is actually contracting. As you can see, we had a reading of 46.3, which is below the 50% level. So that means it is in a region of contraction, whereas the services sector has been printing above 50% for the last 3 months. Although we had a drop in the month of March, but it is still expanding. So even at the US level, the economy is being supported by the services sector, whereas the manufacturing sector is lagging. Now, one of the key important points I would like to highlight from these two surveys are the prices index. Okay, so prices index again relates to inflation. So as you can see, with regards to the manufacturing sector, the prices index has been decreasing and is actually contracting. And similarly, although for the services sector, it is still expanding, but it's actually expanding at a slower rate. So the figure is actually dropping. So that's very positive news. That's very good news with regards to inflation, as we will see on the next slide how this all relates to the upcoming CPI reading. Okay, so these are PMI reports for the month of March. And on Wednesday, when the CPI data is released, that will be for the month of March as well, right? Okay, so this is a chart showing you the correlation between the ISM prices and the CPI inflation index. Okay, so the CPI inflation index is shown on an annualized basis or year-over-year basis, and the ISM prices are showing the average of the manufacturing and services sector. So the ISM average price is depicted by the red line, whereas the annualized CPI is shown in the blue line. So this is quite an important chart because this is actually showing us that ISM prices are actually leading CPI indication, the CPI numbers to the upside and to the downside. So as you can see throughout the years from 2003 all the way till the present month, the correlation between ISM prices and CPI inflation is very tight. So tight, what do we mean by tight? It means that they move together, right? So when the ISM prices moves up, CPI follows suit, and conversely, when ISM prices move down, CPI lags and follows as well. So as you can see from this chart, the ISM prices are actually a leading indicator of where CPI is heading. So clearly, as we saw after the pandemic, and of course with the invasion of Ukraine by Russia, inflation had spiked all the way up to almost 9% on an annualized basis, as shown in the blue line. But ISM prices had actually predicted this move well in advance. So you can see there's easily a lead time of 2 to 3 months. And ISM prices peaked beforehand and started trending down lower even before CPI did. So the ISM prices are a very good leading indicator of where US CPI inflation data is expected to move. So why this is important is because although in the month of February, ISM prices ticked higher, but they've now actually ticked back down again. So this is important because this is telling us that most likely that the CPI number that's going to be printed on Wednesday, 12th of April, is likely to be in line with consensus, and we should see the overall headline CPI move lower. Now, why this is important? Because this data point is going to drive a lot of the moves for this week. So if the CPI numbers do beat consensus and print lower at a headline reading, at the core reading on a month-on-month basis, it is very likely that bond yields will drop, and this would cause the US dollar to drop as well. So the dollar index will drop, causing all the other pairs, all the other majors to move in the opposite direction. And so this is a key event to take note of. So it is on Wednesday, 12th of April, 8:30 p.m. UTC +8. Okay, so please take note of the CPI number because that reading is going to drive the majority of the moves. We will set the tone for the rest of the week and will drive the majority of the moves. Okay, so just quickly, we'll just look at just the Eurozone PMI. So we can see, yes, the global economy is rebounding. We'll quickly look at China, which was the sleeping giant, which has awakened this year. So clearly you can see again, once again, the services sector is driving the Chinese economy, whereas manufacturing is also pushed up, but it has actually come back down. So overall, you can see at a global level and in China and US, the services sector is driving economic growth. Okay, so you can see employment has picked up in China, business indexes has picked up. What is I'd like to point out here is, okay, input price inflation picks up to a 7-month high. So naturally, as China reopens and economic activity picks up, naturally there's a stronger demand for services and manufacturing. Now we've seen some indication of inflation picking up. Now whether this translates to higher inflation moving forward, it still waits to be seen. But as of now, based on what we see from the ISM prices, inflation is like in the US is likely to trend lower. Okay, now that we know how we set up the move, how we set up the backdrop for the for CPI that's coming up on Wednesday, we shall now move on to oil. Okay, so oil, I would just like to start. Okay, before we look at this, naturally we've seen some of the big news announcements last week, where Saudi Arabia, together with its OPEC plus members, led the production cuts for oil, right? So what this means is they are cutting supply. So when there's less supply coming onto the market, with demand being relatively stable or demand moving higher, this naturally pushes the price of oil higher. This is what we saw last Monday when WTI oil gapped higher. Okay, so now that we have that backdrop with us, we are going to look at EIA crude oil weekly stock. So the EIA is Energy Information Administration in the US. It is an energy agency that tracks a lot of information regarding to oil, gas, and other energy commodities in the US. So what this chart is telling us is the number of weekly crude stocks in US inventory. Okay, so just from a general point of view, if inventory is building, or in this case moving higher, as seen in the blue line, it generally means that demand is weak, and thus there's not much oil being consumed from the inventory, right? So when you have less demand, this generally translates to lower oil prices. So conversely, as we see demand picking up, we also expect the inventory to fall. So as demand picks up, inventory is falling, and generally this signals this should translate to an increase in the oil price, right? So we've had production cuts led by Saudi Arabia. We've also now seeing a drawdown in the weekly stocks in the US. So these are all factors that would contribute to oil potentially going higher. Okay, right. So, okay, now we are looking at this chart, which is the crude oil NYMEX. Okay, so this is a futures contract, right? WTI physical futures contract that is traded on the New York Mercantile Exchange. So now why this is important, because this is one of the most heavily traded futures contract on this exchange. So what we're looking at here is open interest. So open interest relates to the number of contracts available for trading. So as you can see, for most parts of 2022, there was very little interest in this contract. But since the start of the year, open interest has picked up and has actually breached 1.8 million contracts, right? So what this means is we are seeing a lot of interest in the futures market for WTI oil. So when we have more interest in oil, we can see there's very likely there's going to be potentially we're going to see more activity and more probably moves in oil. Okay, so we can see open interest has picked up. So activity has increased in the futures market. Now, this chart is showing us the net position of money managers for the crude oil NYMEX contract. Okay, so who are money managers? So money managers usually, I mean, not usually, examples would be the big institutions, financial institutions, as well as hedge funds. So now, if hedge funds and financial institutions, they're picking up activity. So net long means the number of long contracts minus the number of short contracts. So when the net long is increasing, so it was as low as 50,000 contracts and has now shot up to almost about 170,000 contracts as of last week. So what this indicates is that big banks or financial institutions and hedge funds are taking up more positions to the long side for WTI oil. Now, this is important because this is indicating to us that positioning is shifting in the markets. So when money managers were less active, not only money managers were less active, they also had very low long exposure with regards to the crude oil NYMEX futures contract. Now, not only is open interest increasing, the net positioning is also changing and they're becoming more long. So naturally, this implies that the money managers, financial institutions, and hedge funds are anticipating that oil prices should move higher. Now, this is also fits well with the macro backdrop where we have production cuts in oil, and we are also seeing the drawdown in crude oil in the US starting to pick up. Now, this last chart here for this regards to crude oil NYMEX is showing us the percentage of contracts that are net long versus the open interest, right? So as you can see, the net long percentage by money managers was very low, was about 3%, and now it has actually risen pretty quickly to come up to almost 9%. So although it is still a relatively low number, but this sharp increase or reversal in positioning should indicate that money managers are anticipating oil prices to break higher. Okay, so now this is the weekly chart for oil, right? So this is WTI oil. This is the weekly chart. So as you can see, after last week's move over the weekend, right? 2 weekends ago, rather, sorry, 2 weekends ago, where Saudi Arabia announced the surprise production cuts together with OPEC, together with its OPEC Plus members, we saw the price of oil gap higher, and it's roughly been consolidating, and it's not actually moved significantly over the course of the last week, and this week as well is that has had a muted start. But given the backdrop of production cuts, increase, and the potential of increased drawdown in US inventory, as well as the shift in positioning by money managers by money managers on the futures exchanges, we can expect oil prices to probably continue to stay elevated and move higher. So now the first major resistance for oil would be at $83 per barrel for the WTI, right? And will it close the gap? We don't know. Maybe there has to be something really significant to occur for the price of oil to close this gap. But based on what we have just discussed and seen earlier, for now it seems like oil is likely to stay elevated, and the chances of it breaking out to the upside is probably higher for now. But just take note that these are some of the levels to take note on a larger time frame for oil. So you can see the first resistance at $83.70. I guess you could say the first support could be the gap level, right? And then we have the next level at $70.24. Right, okay, so far. Okay, any other questions? Let me see this. Okay, no. Okay, so let's see. Just let me have a quick look before I move on to the next section. Okay, so yeah, question on view on gold and oil. So I have covered oil for now, right? Okay, gold will be coming to in just a minute. Anything else? I see something on pound yen. Okay, okay. We won't be discussing pound yen in specific today, but probably we can try and cover it on the next session. Okay, all right. So I think we are good to move on to the next section. Okay, so we'll look at gold. Okay, so gold has had quite a big move from the second half of last year, right? Okay, partly due to several reasons. Okay, one of the reasons was central banks. So central banks have been buying a lot of physical gold, especially in 2022 as well. A lot of these moves are driven by the sanctions placed on Russia due to them invading Ukraine. So because of this, a lot of central banks have aggressively purchased physical gold to shore up their reserves and to also help prevent currency devaluation as well, right? So, 2022 was one of the highest levels for central banks purchasing gold, and this has resumed, or this trend has continued at least in the first 2 months of 2023. So this chart here is list showing us that we've had almost 140 tons of gold being purchased in the first 2 months, and the biggest buyers were Singapore, Turkey, China, Russia, and India, right? So we've had big central banks buying physical gold in huge demand in 2022, and this trend has continued in 2023. So we know that there's a strong demand for gold from central banks. Okay, now this next chart is showing us gold-backed ETFs, right? Okay, gold-backed ETFs. So this would be instruments that investors purchase, right? So it could be financial institutions, retail traders, high net worth investors. So a combination of or a wide variety of potential players that would buy gold-backed ETFs. So as you can see, after March of last year, there were actually March and April, there were actually outflows out of such ETFs. But however, the outflows have started to reduce towards the end and have finally picked up for the first time in over a year. So we can see that demand is there. Demand for gold is coming from two sources, right? One would be central banks buying physical gold, and also from investors and institutions who would be buying gold-backed ETFs to increase their exposure to gold. So we see strong demand for gold continuing at the start of this year. Okay. Now, okay, just a quick view on who are the big gold producing countries. Okay, so we can see China is the #1 producer, followed by Russia, Australia, Canada, United States. And also China, not only were they the top gold producing country in 2021, they also contributed 9% of total production. Now, not only China is the #1 gold producing country, it is also one of the largest gold importers. So not only is it producing a significant amount of gold locally, it is also importing as well, right? And what is important here is this third bullet point here. The Bank of China, People's Bank of China, has reported 5 consecutive months of gold purchases. Right? So not only is China the biggest gold consumer, the biggest gold producer, their central bank has also been aggressively buying physical gold. So we can see that there's a lot of strong demand for gold coming from central banks as well as the institutions and other investors. Right. Okay. Now, with regards to the direction of gold, where do we think, or where can we expect gold to hit, right? Okay, so this is a chart that shows the performance of gold in relation to real rates. Okay, so real rates are basically 10-year treasury yields, which are adjusted for inflation. So just a quick note, the real yield is shown on an inverted chart on an inverted y-axis on the right side here, and price of gold is in dollars per ounce. So just to quickly see, to quickly just recap, or not recap, but to give a quick overview, is that as real rates go from a position of positive to less positive and to neutral and finally to negative, the price of gold follows suit. So that is to say that as real rates stay positive, remain positive and go deeper into positive territory, the price of gold generally drops. And conversely, as real rates peak and become less positive, heading to neutral and finally become more negative, that creates an environment where gold becomes a very attractive investment. So this is when in periods of negative real rates is where you will see a big demand for gold coming from many players. So you can see this relationship tracks very closely for most parts of time. And similarly, as we saw here, as central banks around the world, led by the Federal Reserve, started raising rates aggressively, real rates went from a position of negative 0.8% all the way to 1.6%. And in this same period, the price of gold has followed suit. But when real rates started to peak and started to move, they consolidated for a while before now becoming less positive, the price of gold has also increased as the dollar index has fallen and as central banks have become big buyers of gold. So you can see there's a lot of fundamental reasons behind why gold has moved as such over the last 2 years. So looking at what real rates are doing in combination with what the dollar index is doing will help us estimate will give us a good indicator of where the price of gold is going. So which again brings us to the CPI data coming up on the 12th of April. So if the CPI data does print lower or in line with consensus as what we expect based on what we have seen or what we have discussed earlier, it is very likely that bond yields will fall. This will also cause the dollar index to fall, and thus this would make gold a good investment opportunity. So we should also expect the price of gold to move higher should the CPI data be in line or be better than what is forecasted on Wednesday. So once again, the CPI event is going to drive a lot of the moves for gold, for FX, for this week. So once you know what DXY is doing, we will also know what the other currency majors will do, and we will also know what gold will do. Okay, so this is a weekly chart that shows us the performance of the US 10-year bond yield together with gold. Okay, so just to quickly point out that what we see here on this chart, real rates, the line shown in black, this is the bond yield that has been adjusted for inflation or inflation expectations. Whereas here on this chart, this is the nominal bond yield, okay? So this is not adjusted for inflation. It is just showing you the nominal yield of the US Treasury bond. So as you can see, in this last three blue lines, whenever the Treasury bond yield, the 10-year bond yield has peaked and moves lower, the price of gold has also followed suit, right? So in the early 2022, we were a major geopolitical event took place, right, with Russia invading Ukraine, and the price of gold actually spiked, right? But after that, gold actually pulled back pretty significantly, right? You would think that after a major geopolitical event, the price of gold should continue to rise. But no, actually, the macro fundamentals took over. So, what was happening here during this period? Not only did we have a major geopolitical event, central banks around the world were also combating inflation. So they were targeting inflation, and to do that, to tame inflation, they have to raise interest rates aggressively. So with the Federal Reserve leading the charge, they aggressively raised interest rates, causing bond yields to rise, which also caused the dollar index to rise. So this is a scenario when bond yields were rising aggressively together with the dollar index, and this is an environment which is not favorable for gold. So that is why we saw that gold started to pull back pretty significantly for most parts of 2022. And what happened in the latter part of 2022 was bond yields started to peak and the dollars started to peak as well, and they both started falling in tandem, and with the dollar index making significant moves down from its peak. So in that environment with falling bond yields, with falling dollar index, this sets up a very good tailwind for gold. So as you can see, gold from about, I think, 1,800 has now obviously pushed through 2,000 a couple of times, and it has breached this $2,000 level, or it has breached a significant $2,000 level. So what we're trying to show here is that bond yields and dollar index are important. The direction is important because it dictates where the price of gold is likely to head. So now the next chart shows the performance of DXY versus gold. So as we can see clearly, and we can compare the two charts, as bond yields were rising, the dollar index was rising. This was negatively impacting the price of gold. So this will be, so once you know the macro environment, you know on the longer time frame what are the ideal setups. So now you could use this information and trade. Well, you don't have to use, then you trade according to your specific strategy or your trading style. So it could be on a daily chart, 4-hourly chart, or 1-hour chart. So this would be an environment where you would be looking to take short positions on gold, right? So as the dollar index was rising, bond yields were rising, it creates an unfavorable environment for gold, and we'll be looking to short gold over a longer term, longer period, and also depending on your trading strategy and time frame, you would scale it down accordingly. And then as soon as the dollar index peaked in third quarter, bond yields also peaked. They both started falling, with DXY making significant moves to the downside. So this actually sets up a big tailwind for the price of gold, which is clearly illustrated here in the last 4 months of 2022, and also at the start of 2023. And at the start of the year, we had the DXY bottoming here temporarily before rising together with bond yields. So in this environment here, we can see here, right, bond yields also rose, dollar index rising. This impacted the price of gold, right? So you can see to the upside and to the downside. Once you know how DXY and bond yields are performing together, it will help us identify the general trend. Is it an uptrend or downtrend for the price of gold? And we are able to execute our strategies accordingly. So similarly, as we've seen recently, in March, the DXY peaked, bond yields peaked, and both started falling. They set up the next tailwind for the next leg up for the price of gold. Okay, so once again, just to conclude, for the direction of gold, we would look at bond yields, look at the dollar index. This will help to give us a very good indication of where gold is likely to move. And once again, this brings us back to the CPI data coming up on Wednesday, because the CPI print is going to be closely watched by everyone. And the moves from bond yields and the dollar index after that event is going to drive a lot of the action for the rest of the week. So please take note, everyone, there's going to be an important event. So please pay attention and do your due diligence for all your, for any of your potential trades and setups. Okay, just quickly move on to US equities. Okay, so once again, the bond yields are dictating the moves of the dollar, of the S&P 500 as well. So especially towards the second half of the year. So as bond yields fell, the dollar index fell, financial conditions are loosening. So as financial conditions loosen, they provide a tailwind for equities in general. So similarly, when bond yields are rising, the dollar index is rising. It means that financial conditions are tightening and they create headwinds for equities. So this is why bond yields and dollar index are not only important for commodities such as gold, is also important for the equity markets as well. Okay, so similarly, if bond yields, if the again, this comes back to CPI. So if bond yields, the CPI prints in line or better than consensus, and we have headline CPI, core CPI trending lower on a monthly basis and annualized basis, it is very, very likely that bond yields will move lower, which will drive the next leg up in equities as well. So you will see your S&P 500 and your NASDAQ potentially breaking out higher this week. Okay, let's just quickly look at market breadth. So the S&P 500 is an index, right, made up of 500 companies. So this is seen on the top where we have the weekly chart, and this is a 50-week moving average. So the price or the index has broken through the 50-week moving average. And the second chart below is showing us market breadth. Okay, market breadth here is calculated by the percentage of stocks that are trading above the 200-day moving average. Okay, so this is important because this tells us whether the current rally or the current move in equities, is it a broad-based rally, or is it only a handful of companies that are driving the index higher? So when you have at least 50% of the companies in the S&P 500 that are trading above the 200-day moving average, it means the majority of them are pushing higher, and it's a healthy stock market because the index is propped up by a wide number of companies. Whereas in the NASDAQ, although the NASDAQ has made a much stronger bounce, you can see the market breadth here is only about 31%. Now, this implies that the move in the NASDAQ 100 is primarily driven by the mega cap companies, because the mega cap companies have a higher weightage in the index compared to the rest of the companies. So this means only a handful, or not only a handful, but only the mega cap and large cap companies are driving the move in NASDAQ, whereas many smaller and medium-sized companies are actually probably pulling back again. So this is telling us that the rally that we are seeing in the S&P 500 is far more healthier than the rally that we're seeing in the NASDAQ 100. Okay, right. Okay, I've come to the last slide for today's webinar. Right. Okay. Just before I go into this, are there any further questions? We've had just a few questions regarding to gold and oil, which we've covered. Right. Okay. So just before going into the calendar for this week, so we've talked about the NFPs, we've talked about PMI reports, inflation figures, and what to expect for this Wednesday's inflation data. We've also looked at oil and gold and what are the moves that are likely to take place this week, right? And also for equities as well. So this is the calendar for this week, 10 to 14. So this is looking at using Forex Factory, and I filtered the calendar, so we will not be seeing every single bit of data of event, every single event that's going to take place this week, but we're going to look at the critical and the most high impact data that will take place in that would involve the US dollar, the sterling pound, the Canadian dollar, Australian dollar, and all the majors, right? So basically euro, yen. So based on all the filters, this is what we are will be looking forward to this week. So Monday night is a quiet night. Tuesday is quiet as well. 8:30 p.m. Wednesday, 12th of April. So 8:30 p.m. UTC +8 is when the biggest event of the week is going to take place. So this will be driving all the moves in bond yields and the dollar index, and subsequently that is what will lead the price of gold, the price of equities, and also it will probably have some impact on oil as well. Okay, so we also have the governor from the Bank of England speaking at 9 p.m. UTC +8. We also have a monetary policy report by the Bank of Canada. Okay, so in this event that will take place on 10 p.m. UTC +8, it is widely expected that the Bank of Canada will maintain interest rates. They're not going to cut, they're not going to hike. So this will, the markets are expecting a pause by the Bank of Canada, and then followed by the press conference at 11 p.m. And we also have the FOMC meeting minutes, which will be released on Thursday, 13 April, 2 a.m. UTC +8. The contents of this meeting may also continue to drive bond yields and the dollar and the strength of the dollar. So this is another event that we would have to pay attention to. And then we also have the Australian employment change and unemployment rate, followed by GDP numbers in the UK. And we also have core PPI and PPI readings. So PPI is producer price index. So this is wholesale inflation. So this would relate to inflation coming from the manufacturing sector. So as we've seen in the ISM reports for the month of March, prices have actually been contracting. So we can also forecast that this reading is expected to head lower. So PPI and core PPI on a monthly basis and annualized basis are expected to drop. And once again, this will drive the moves in bond yields and the dollar index as well. Okay, so I've come to the end of today's webinar. Okay, just let me check if there are any questions, guys. Any more questions? If you have any more questions apart from the gold and oil, please feel free to send them in. Right? Is there anything else, guys? Hang on, let me look through the app and see if there's any further questions. Okay. Yeah, I don't see any more questions on Zoom. Right, I don't see any more questions on Zoom. Okay, just let me check the Vantage app again. Okay. Right, okay, I don't see any other questions. All right, okay, so basically we've covered gold, oil, and inflation. So yes, okay, guys, hope you had a great weekend. And yeah, just pay attention to this Wednesday's CPI data, right? And yeah, so watch out for the moves in bond yields, watch out for the moves in dollar index and the main CPI reading. And this is going to drive a lot of the moves for the rest of the week. right? I hope this has been an informative session for everyone, and I look forward to seeing you guys for the next one. All right, take care and have a good trading week. Right, take care, guys.